So welcome everyone to the second ABC blockchain talk. My name is Alexander Eisler. I'm Chief Scientific Officer of ABC Research, or the Austrian Blockchain Center. For those who don't know us yet, we are an interdisciplinary research institute based in Vienna, focused on blockchain and related technologies. So together with quite a large number of scientific and company partners, we conduct applied and basic research related to various topics in blockchain and crypto assets from across various industries, from financial services to manufacturing. Our research is partly funded under the COMET program of the Austrian Federal Financing Agency. If you want to learn more about us or do research with us, please don't hesitate to get in touch. You can find my contact details later. With that, I'm very excited that we have a very interesting topic today on laundering money with crypto assets, known strategies, and containment methods. And we were able to get very renowned experts on this field to talk about that today. First of all, Elena Scherschneva, who is an Austrian-based freelancing anti-money laundering and counter-terrorism financing expert and trainer. She's also the founder of the AML Academy, and at the moment she's one of Austria's leading experts in this field. The second talk will be by Bernhard Haslhofer, who's a senior scientist at the Austrian Institute of Technology, where he acts as team coordinator in the research group Data Science and Artificial Intelligence, and he has done a lot of research on crypto assets and tracing of crypto assets. And with ABC, he is also the area lead of our data science area. I'm very much looking forward to the talk. Before we come to that, maybe let me quickly announce two future events. So our ABC blockchain talk is supposed to be a monthly series. The next talk will be on the 4th of March at 5 p.m., where Zoltan Fatsekas and Matteo Maffei from TU and Teratech will talk about formal verification and security of smart contracts. And I'm also excited to announce our first annual conference of the Austrian Blockchain Center, which will take place on the 23rd of March. And participation there will also be free. So if you're interested in more information and would like to register, please go to our website or follow us on LinkedIn. With that, I would like to hand over to Elena to give the first talk today. Thank you.
Okay, thank you, Alexander, and thank you for having me here today. And also very much thank you for that kind introduction that you have made. So as you already heard from Alexander, I'm an expert in the field of anti-money laundering and counter-terrorist financing. I'm not an expert in technical matters of cryptocurrencies. That is why also our second speaker is here, who will take over after my part. And what I will talk about in the next half hour is about money laundering, terrorist financing, and how it relates to cryptocurrencies. So especially about questions, what is money laundering, what is terrorist financing, how can criminals use crypto assets and cryptocurrencies to launder money and to disguise financial flows for terrorism financing, and especially also the challenges that you experience in the compliance area. And I remember when I first heard of cryptocurrencies, it was back in, I think it was 2012. So this was the time when the Bitcoin hype, let's say, came up in Austria already a little bit. So first people started talking about it. And then all international organizations and also all national authorities started to just think about and guess how cryptocurrencies can be used for money laundering, what's the danger, what's the risk, how we can handle that risk on a coordinated level. And now we have it 8 years later, so we have 2020 now. And you see that quite a progress have been made here. So the Financial Action on Task Force on Money Laundering, the FATF, already issued some guidance for cryptocurrencies and money laundering in the past months or even years now. We also have the Anti-Money Laundering Directive, which also brings all that crypto asset provider topic into the regulation aspect. So in Austria, we currently have the situation that virtual asset service providers are already a subject of supervision by the Financial Market Authority. So they have to follow the same rules as the whole financial sector does. And that's actually a very big step forward and a very, very important step to tackle money laundering. But first, let us talk about what is money laundering? How does it look like? How does it happen? And to tackle that question, I want to share my screen with you because I have prepared some slides. And I hope that afterwards things will get much clearer now. And I'm very aware that some of you have more experience, maybe specific in the sector of AML CFT already, also with compliance systems and so on. But I guess that also some of you haven't got in touch with money laundering in a very intense manner so far. So I will start like from the scratch, and I want to present a case just to show you how money laundering can happen. And that's not a crypto case, but it's a very good one just to understand how the whole thing works. And in this case, there was a couple of people, of criminals, who committed crimes in terms of they broke into houses, they broke into flats, and they have stolen some things there. So typically they have stolen money and cell phones, also cameras, laptops, and much more. So everything that is of a certain worth in a house, in a flat. And so they took all the things with them, and in a first way, they needed to turn all that things into money, because you when you have a used phone or a used computer as a criminal, it's nice, but you need the money, so you make the whole thing for profit. So what they did is they converted it into money. This money was collected by other members of the criminal organization and finally brought abroad. So the trace was a little bit, they had a break in here. So the other activity took place abroad. And that was where the money was again transferred. So it was invested into luxury goods like boats and very expensive cars. It was also, well, that looks like a mouse, but it's actually a luxury car. So I just try to imagine. And also different assets of worth. So they also invested it into real estate and into different types of immovable objects. Then they also invested it into enterprises, and they built up some cash-intense businesses such as restaurants and gambling places and so on. And with that, the money was laundered. So what they received here is the profit from all that legal activity, which was powered by the illegal money that they put in here first. And then there was again a cross-border action. So they switched to a third country, to Russia. And in Russia, the same activity took place again, with the difference that the subjects they were investing in were much more expensive, that the real estates were much more expensive, and that the companies were even bigger. And from Russia, the money was moved back to Austria. And here already the money had the purpose for buying large real estates, to invest in international companies, to invest also in different kind of stocks, and so on. And this case just shows the process of a possible money laundering from the very small part here in the beginning until it's really big and international here at the end. And that's the reason why I presented so often during trainings, because here you still have a very strong connection to the crime, to the predicate offense. So when you start your investigation here, then it's quite easy to say, okay, these people are criminals, they do these breaks into houses and so on, they steal money from people, and that the money is dirty. When you start investigating here, it's almost impossible to tell where this money comes from. And we don't need to talk about that. You can't see that, let's say, a part of this money is coming from a flat that was where a theft took place in Austria, because we already had 2 cross-border operations here. And when we talk about the concept of money laundering, you need to know that it's divided in 3 stages. It's one of the models to explain money laundering, and I like it very much because it's quite simple, and that's actually the best to understand it. So first of all, you need a predicate offense and a criminal behavior. Then in the first stage, criminals try to place all that criminal assets into the economic circle. So they make it by using straw men or straw women. They structure the assets, which means when you, for instance, sell drugs and you receive like $3,000 for these drugs, then it's always easier to part that money among 5 people, and these 5 people invest it, and then it's a smaller amount of money, which is harder to trace. Also, a very good thing to bring the money into the economic system is the use of cash-intense businesses. I mentioned it before. So meaning when, for instance, you have, let's say, a gambling casino and people come and pay cash, then it's also possible that some members of the organization come and pay their cash coming from the criminal activity. And then it's in the system already, because then you can start turn over the money, and at the end of the day, it will come out as a profit of the casino, for instance. So that's the first part, the placement. And the placement very much depends on what kind of criminal assets you have. Because when you have, let's say, to make also the bridge to the crypto asset topic. In Austria, we had a very popular criminal behavior, and it was like people received emails. The emails told the people that, okay, we fooled around with your computer, we have all your data saved, and if you don't pay us an amount X of Bitcoins at a specific wallet, then we will just either kill your computer, or we will damage your reputation by telling other people what you have on your computer or stuff like that. So in that case, you would have even crypto assets as the first asset that you have. And so you would receive it then as a crypto asset service provider. And that's already one of the challenges that we have on this crossroad between money laundering and crypto assets. It's quite hard to trace where the assets come from. So Bernhard will talk a lot more about that afterwards. But the thing is, when you want to know where the money comes from, or the asset comes from, so when you want to know what this predicate offense is, then you need to trace back the way. And of course, there are some providers that already can indicate if a coin is a tainted coin or not, but still it's quite hard and it's not very reliable. So back to money laundering, the second stage of money laundering is the so-called layering stage. That's the time when criminals just move the money around like crazy. So what they try is they try to conceal the criminal origin of the money, and there are some typical models to do that. So the biggest one, and they are very interconnected, is the foundation of companies, of enterprises with also complex structures to make the whole thing very complicated. So then the companies also use bank accounts, they use bank transactions to change the form of assets. And what does change the form of assets mean? That means that on the one hand, the purchase of luxury goods, as mentioned before, is a very important part, where you just turn, let's say, euros into a boat or diamonds or a real estate, but you can also purchase virtual currencies and stocks. Just to change the form of the asset and to conceal the paper trail further, and to conceal the origin of the money. And after that second stage, after that layering stage, the third stage of money laundering would be the integration. So it's the regaining of funds. And found is well integrated when a criminal can, let's say, present any bills or any invoices, any justification to have his or her money. So meaning that everything that serves this purpose in the stages before is of high value for the criminals. And of course, it's up to you as a provider. You know your products, you know your clients, you know what is possible with your product. So you shall just ask yourself the question, what can a potential customer do after he or she has consumed my services? So does he have any invoices? Does he have any other paperwork that just proves that the money is from a legitimate source? So for instance, when a person then goes to a bank and says, okay, I know it looks quite unlikely that I have 10,000 euro now, but I have invested in Bitcoins before, and that's my gain from the whole thing. So that's the issue. And in connection to cryptocurrencies, this placement stage also plays a very big role, because I guess that all of you know that we have such a thing as the darknet, and the darknet is used by criminals as a marketplace. So actually to sell drugs, to buy drugs, to sell or buy or consume let's say other forbidden things like child's porn and so on. Also to gain to acquire criminal services such as hackers, to buy fake IDs and so on. And that means that it's quite likely that the one or other customer has his or her criminal assets from the darknet, and he will transfer them somehow on a different level, and wants to make them to fiat money again at the end of the day. So that's these are the things that you have to keep in mind. So as said, the asset is clean when the connection to the predicate offense can't be proved anymore. And when we talk about money laundering, then we have first of all the predicate offense, and then we have all that layering process and integration and so on, so which can be described as hiding and disguising activities. So when you talk about money laundering and when you want to prevent money laundering, then you need to ask yourself the question, where did the money come from? So you need to trace back this way. And that's the direction you look to. When we talk about terrorist financing, the whole thing is different, because on the first hand, you have either illegal or legal money. So this can be like money or assets that come from criminal activity, from extortion, maybe from robberies, from smuggling of human beings, or also assets that come from a legitimate source, such as when let's say NGOs collect maybe monies, or when people also collect money within the family. We had a case in Austria where the whole family has sold everything that they have. So they sold the car, they gave up the flat, they gave up the life insurances, and then they took the money and went to an ISIL camp to become a terrorist. So that's the way it can go. And then in a second step, when we talk about terrorist financing, you have collectors. So you have either persons or organizations that collect the money, and then the money is used for illicit activities. So that means that in the compliance, when you talk about tackling terrorist financing, you need to look how the money is used, not where it comes from. So it's a change of direction. And these two factors also make, when we talk about crypto compliance, so compliance of crypto asset providers, they make it very hard to or not to focus, but to even choose on what you shall focus in your compliance activity. Just a brief overview of compliance activities as such, and I want also to use this opportunity to talk about actually these challenges that you have. So on the first place, you have the risk analysis, meaning that you should know your risks, you should know where the risks come from and how to mitigate them. Based on that, you build your risk-based strategies and processes. So meaning that you may have an onboarding policy, you may have a policy how your employees decide when to file suspicious transaction reports and so on. Then you have these basic documents that tell the employees what they should do and when they should do. And the last block is the employee training. And when you look at this whole sector, then you need to know that this is definitely a legal requirement in every country. So the whole system behind it comes from the Financial Action Task Force on Money Laundering. And for Europe, for the European Union, it's brought into life latest by the 5th Money Laundering Directive, which also included all the crypto asset service providers into the circle of reporting entities. So you need to have all that system, strategies, processes, and controls in place. And there we are not talking about dealing with the individual customer at that point. It's just the thing that you need to have in your company, irrelevant what type of products you're offering and what clients you deal with. At the second level, we come into the core KYC. So these are the things that you need to do with each individual customer, applying a risk-based approach. So it's the identification of the customer, of the beneficial owner, or of the beneficial owners when we talk about companies. Also, the check if a customer is a PEP or not, information about the background of the business relationship, meaning that you need to know if a customer is buying crypto assets because he or she wants maybe to speculate with them, or if the customer wants just to have an alternate source for to keep his wealth, or if the customer needs crypto assets because he or she wants to pay something specific with them, which is not maybe possible with fiat money. So you need to know why your customer is doing the things that he or she is doing. And then also ask question about the source of funds and the source of wealth, which means you need to get a feeling for your customer. And if, for instance, someone is buying crypto assets for a total worth of 15,000 euro, then you just need to let's say to question if this person is even able to have this money, or if it's maybe already illicit money. And these questions are part of the KYC process, so you need to ask them. And when we think about the why you need to ask them, then it's so you can have a proper rating and a plausibilization. The concept of money laundering prevention is that you need to know your customer, because only when you know your customer, you know if the customer is behaving in a manner that is in his range, let's say. So you can detect suspicious activity easier, and you can risk rate the customer easier. So after you have all that information, what you do is you make a rating, you risk rate the customer, and you check if the information is also good. So the challenges that arise in the area of crypto assets here are that a lot of transactions are actually made in tinier parts. So specifically when you're dealing with transactions, I don't know, where just very small amounts of virtual assets can be purchased, and you may have some thresholds here where the KYC does not apply. It may be that your product is designed in a way that the KYC applies only from a certain amount. And the practical challenge is how you keep an eye on the fact that all of the small activities do not exceed the threshold when you count them together, because that's also a factor. So this is definitely one of the challenges. Another challenge when we talk about what happens then, so after you onboarded the customer, the anti-money laundering directive foresees that you monitor the business relationships, meaning that you compare the customer with his KYC profile, you compare him with similar customers, and you look for irregularities in his transactions, and you need to make risk-based updates. But in my experience, most of the customers that virtual asset providers are dealing with are not long-term customers in the sense of that you really can monitor them. So what's the most typical behavior is that you have a one-time purchase, and then either you are also a wallet provider, and then you have the cryptos in your influence, let's say, or you are not a wallet provider, and then the customer just is gone. And in Austria, the Financial Market Authority also on a regular basis asks, okay, and how do you ensure monitoring? And that's really a challenge. I also don't have a best how to do answer for you at this point, but that's definitely one of the things that are discussed and that also should be discussed. When we let's say, to close this topic of the system strategies and so on, what you need definitely as a crypto asset service provider, when you have all your systems and so on in place, you need an AML reporting officer or any person that serves in a similar function. So especially if you're a little company, it's quite state of the art currently to outsource this AML reporting officer position. which I personally am not a very big fan of, because you still need a person within your company, within your enterprise, who is just familiar with all of that provisions that are there, who can meet very fast decisions, and also good and fact-based decisions. And the task of this anti-money laundering reporting officer would be to deliver the strategic input into all of that strategic compliance system, and also to perform the operational control that the KYC and the monitoring is performed in a good manner. So yeah, I will close the sharing of the screen now, if I manage. Just give me a second, because all my Zoom control pad has disappeared. So now I think I have it. So yeah, to sum it up, AML, CFT, and cryptocurrencies are quite a young pair, let's say. So there is still a lot to learn, and one of the biggest challenges, in my opinion, will be in the future the tracing of transactions backward and forward, so you can be sure that your client does not come up with tainted coins, that your client does not use his coins for terrorist financing activities. And the other thing is definitely the challenge with the ongoing monitoring and with setting the border where this ongoing monitoring is required and where it's just not practical to do it. And then the third challenge, maybe also to explain to the regulator, to the supervision authorities, how your system works, to make them understand, because what we have as experience from Austria is that the regulator sends different supervising teams on site, and that these teams are very financial sector knowledge based. So not every one of them exactly knows how to deal with crypto assets. And yeah, these three challenges actually make it a very, very interesting area, this crosscut between money laundering, terrorist financing, and virtual currencies. So that's actually my input from my side. I would hand over to Bernhard now, and I will, of course, stay available for the question and discussion round after Bernhard's presentation. Thank you.
Yeah. Thank you, Elena, for your interesting talk. As you already mentioned, maybe before I hand over to Bernhard, we will take questions to both speakers at the end of both talks. Thank you.
Okay, so assuming you can see my screen and hear me, I would like to thank Elena for explaining to us what money laundering and terrorist financing actually is, and that there is a connection to crypto assets. What I will now talk about is how we can mitigate, maybe prevent, or at least contain money laundering using some specific methods for tracing and tracking, which I would subsume under the umbrella term crypto asset analytics, which somehow has become a research field over recent years, and I'm very active in this field. And interestingly, has also become a very important business if you look at the players that are currently active in this field. So just a second. Let me start maybe by explaining to you what I mean when I'm talking about crypto asset analytics, just to give you the broader picture, because money laundering and terrorist financing is just one aspect. So for us, crypto asset analytics is really about finding measurement methods and tools that help us in understanding the technical and socioeconomic aspects of crypto asset ecosystems, and looking into individual transactions and transaction flows is part of this. And we are doing this for different purposes. So market understanding is one use case, law enforcement is another one. We are also working with protocol designers who work on proof of stake because they want to know how their protocols might behave under real world circumstances, etc. And of course, increasingly, we are confronted with issues from compliance and regulations, sorry, who also have to deal with tracing and tracking crypto asset transactions. I would argue that AML and CTF is probably most relevant in these two areas. So law enforcement and compliance and regulation. Compliance and regulation is something most virtual asset service providers nowadays have to deal with. Elena already nicely summarized the two big questions that are relevant when we're talking about AML and CTF. And these questions are, where does the money come from and where does the money go to? And if someone is running a virtual asset service provider like a cryptocurrency exchange, compliance people in these organizations have to think about these questions. And fortunately, nowadays, there are some methods around which can be used in order to answer these questions. And I don't want to go into all the technical details, but I would at least explain you some basic techniques that are used nowadays by anyone who is interested in tracking and tracing crypto asset transactions. The first technique is actually a technique that has been proposed by Nakamoto himself. He said that addresses can be clustered based on transactional behaviors, and that's actually true. So what can be done is you can look into the blockchain and really build clusters of addresses that are somehow controlled by the same real-world entity. A real-world entity could, for instance, be a virtual service, a virtual asset service provider, or an individual, or an organization, or whatever. So address clustering is known for, I would argue, almost a decade now, and is an integral part or the most important technique in most tools nowadays. The second important technique that is used or must be in place when tracking and tracing crypto asset transactions is attribution tagging. This basically means you need to know for specific addresses what their real world counterpart is. So for instance, you need to know that address 1, for instance, is controlled by some crypto asset exchange. And if you have such a piece of information, which can be attached to a single address, and if you combine this with the clustering I mentioned before, you can actually effectively de-anonymize entire clusters and really combine large sets of addresses. So these are also called on-chain de-anonymization methods. And the next steps, the next step that's usually implemented is building an abstraction that helps analysts in investigating monetary flows in crypto asset ecosystems. So what you try is you really try to build a network in which the nodes represent real-world entities like exchanges or organizations, and the edges between nodes represent monetary flows. This is the so-called entity graph. And all products that are in place right now, they basically use these techniques. Just to go a bit deeper technically, to explain you how the address clustering works, because this is a very frequent question. I'm just explaining the most basic technique, and it's actually very simple. So most of you are probably familiar that in Bitcoin, a transaction can have multiple inputs and multiple outputs. And what you do with the co-spend, so-called co-spend heuristic, is you look into on the input side, And if you see that one transaction uses several addresses as input, you can safely assume that these addresses are somehow controlled by the same entity, because the entity that executed the transaction must somehow possess the private keys. There are certain exceptions like coin joins. I don't want to go into the details, but in general, this heuristic applies. So you can say, okay, A1 and A2, they belong together. They are controlled by the same entity. If you find another transaction in the blockchain, TY, and you see again two addresses, A2 and A3, you can apply the same rationale and say, okay, these addresses belong together. And now, if you see in two clusters, they're basically the same addresses, you can make another inference step and say, okay, all these addresses belong together. And this is really important because those clusters can become really large. So we have clusters of 900,000 addresses or even more. And those are typically clusters representing exchanges. And just to show you what attribution tagging means. So if, for instance, I know that a certain Bitcoin address, so here I'm just using the Bitcoin address used by the Internet Archive in San Francisco, which is used for donations, and I can find this information on the web. I basically have a real-world attribution, and I can assign this attribution to a single address. So this is what I get from just looking on their website. And of course, if I can attribute a single address, I can also attribute an entire cluster. So this is the whole idea, the most basic technique that is nowadays used for crypto asset analytics. Of course, in reality, there are far more advanced things out as well. You might also be aware that there are several tools out in the space. So the market leader is Chainalysis. It's US-based company focusing on blockchain analytics. Then there is also CipherTrace, also in the US. And these are commercial tools and can be used as a service. On the other side, we also have, I would argue, important open source developments. So we have a BlockSci, which is a low-level Python library developed by Princeton University in strong cooperation with University of Innsbruck. And we also have GraphSense, which is pushed by AIT and I would argue made in Austria. And I would also argue at the moment probably the most powerful platform out there at the moment on the open source side. So let me quickly switch my screen so that I can show you what this means in practice. I will give you a quick demo demonstrating how Cryptoasset analytics can look like when using such a tool. Stop sharing. Share difference. Yeah.
By the way, your video is not working, Bernhard.
Okay, sorry. Better?
Yeah.
Okay. So again, this is just a quick demo to give you a basic impression what you can do. So this is a demo, the demo dashboard we built for our platform. And what you can do is you can investigate a certain address, and usually investigations start with certain addresses. And you can look up information about this address. So for instance, you can see aggregate statistics telling you how much, in how many transfers this address was involved in, how many withdrawals and deposits it was involved in, for how many years it was used, how many Bitcoins it received, how much is still left. So this is all aggregate statistics that can easily be retrieved from a blockchain. But more importantly, you can now look into real-world relationships to other entities in the crypto asset space. So I told you before, address clustering is the most important technique, and I started with a single address, so that's this 18NSAYBF address. And here I see, okay, it seems that this address is part of an entity that controls actually 12 addresses. So I basically shift my focus from the level of addresses to the level of entities, and an entity always represents some real-world entity. And of course, I can then look at the same statistics in an aggregated fashion. And most importantly, I can now start looking into financial flows. So I would like to know, okay, where did the money go to? And I just open the graph and I see, okay, these are the entities that received money from my focus entity. I don't know all of them, but here I suspect that this might be an exchange. I just don't know which one. But here I see, okay, there were 3 transactions to Wasabi. Wasabi is a mixing service, which is can be used for hiding transaction flows for legitimate, but also for illegitimate purposes. We also see that there is a connection to some exchange. I see that it's I suspect that this is an exchange because this cluster actually comprises almost 1 million addresses. And we also have attribution information available. So I see that this is probably Poloniex, which is a well-known exchange. So this is what can be done to answer the question, where did the money go to? And of course, I can also answer the question, where did the money come from? And just to give you an idea, so I see here, okay, there are relations to, for instance, Shapeshift. Shapeshift is a service that allows conversion between different crypto assets. And at the beginning, when Shapeshift started, they had, how can I say, there were some issues with compliance, and there is some transactions might have been involved in less legitimate purposes. I don't know if this is still the case, but it's just an example of how transaction flows could look like. I can also do some systematic search. So I can now look into all the exchanges that sent money to the entity I'm interested in. And this takes a while because the graph we're searching is actually really huge. So the thing contains hundreds of millions of edge nodes and billions of edges. So it takes a while, but usually if our server is not under too heavy load, it should return some results quickly. Let's give it a few more seconds. But what I will hopefully see is all the exchanges that transferred. Yeah, here I see, okay, where did the money come from? And I see via 2 hops, there were some well-known exchanges involved. So honestly, I don't even know what or who this entity is. This is just for demonstrating, for demo purposes, to give you the basic idea what it means to find an answer to the question, where does the money come from and where does the money go to? Let me now switch back to my presentation. Can you see my slides again? Yeah. Okay. So this is basically, so what I showed you or what I talked about right now was basically the state of the art. So this is how state of the art cryptoasset analytics works at the moment. And if I have to summarize the state of the art, I would argue as follows. When we are talking about crypto assets, we're actually talking about a spectrum of different types of crypto assets. And I know there are many taxonomies out there. I disagree with some, agree with some others. So for this reason, I came up with my own. And what I do is I basically distinguish between native cryptocurrencies and tokens. So Bitcoin is an example for a native cryptocurrency, and there are also draw a distinction between privacy-centric currencies and others. And on the other side, I consider tokens something different because they simply have a different technical nature, and they're also running typically on other types of blockchains like account model blockchains like Ethereum. But what we see is that current tools actually, they almost exclusively just focus on native cryptocurrencies. So you can analyze Bitcoin, Bitcoin Cash, all sorts of derivatives. You can analyze transparent transactions in Zcash. You can actually not analyze Monero. So maybe this purple line should be a bit to the left. You can also analyze Ethereum transactions, but only those that are basically working like Bitcoin transactions. So what we see is that tool support is rather narrow compared to the spectrum of current crypto assets out there and the spectrum of abuse as well. So what are the challenges we are facing in this field right now? And I picked, there are many, but I picked 3 important ones. The first one is analysis of token flows. And here I'm just borrowing explanations from my colleagues at the University of Innsbruck who summarized this in a very excellent way. And the point is, in account model ledgers like Ethereum, there is something called smart contracts. I assume most of you have heard about this, but let me explain just to be on the safe side again what this means. So in Ethereum, what you can do is you can actually deploy programs on the blockchain. So you store them, and those programs can be triggered by transactions. So let's assume we have a smart contract that just accepts donations and encodes a very simple program that says, okay, if I receive a donation, then increase the counter by 1. Then I can, or Alice can trigger this smart contract by sending a transaction and saying, okay, I would like to donate 1 Ether. And the smart contract, so the program running on the blockchain, then changes the state and basically increases the balance and the number of donations. So this is the basic idea of a smart contract. So a smart contract has nothing to do, it has nothing to do with a legal contract. It's really just a computer program that encodes state transition rules. But now comes the important point. A smart contract can also be used to implement a token, and anyone with basic programming skills can do this within probably 15 minutes. So anyone can deploy his or her own token on the Ethereum blockchain, define the number of units available, and encode some simple bookkeeping rules. For instance, this smart contracts tracks the balance and tracks the value assignments to different users. So for instance, in this smart contract, Alice has a value of 2 Ether and Bob has value of 0. And the smart contract also encodes some simple rules, which basically say, okay, if I receive a transaction, then I shift the balances. And this can be done on the blockchain. This is done. So smart contracts, token systems, tokens can be triggered by transactions and actually really cause shifts in values. So value transfers between users. So before Bob had 0 and Alice had 2. Afterwards, Bob had 2 and Alice had 0 Ether. So there was some value transfer, but this is of course not visible if you just look at Ether transaction between externally owned accounts on the Ethereum blockchain. So the big message is, if in account model ledgers like Ethereum, if we only look on transactions between externally owned accounts, so these are basically accounts like similar to addresses in Bitcoin, even though it follows a different conceptual model. If we only look into these transactions, we miss the big picture, because we miss all the value transfers that happen within tokens and between tokens and smart contracts. So this is a challenge, and the goal, or the goal is really to extend tool support to also investigate token flows. So this is what I would argue one of the greatest challenge we are facing at the moment. The second challenge is also important, because if certain technologies succeed, they could basically render all existing techniques useless, because it might happen that transactions don't show up on the chain anymore. And there are different approaches, and one approach are so-called payment channels. And the motivation for a payment channel is a very simple one. So most people probably know nowadays that blockchains have a real scalability problem, which prevents them from processing large amounts of transactions. So for technical reasons, in Bitcoin, you can process roughly 7 to 13 transactions per second. The reason why it's not possible to execute more is because the blockchain is actually replicated among peers. So this might change with future implementations of future blockchain implementations and protocol implementation, like in Ethereum, for instance. But still, reaching the peak capacities service providers like Visa have in peak times is a major issue. And for this reason, people are currently investigating different techniques. And the idea of a payment channel is really to conduct the bulk of transactions off-chain. So do not store transactions on the chain. Use the chain only for settlement and resolving disputes. So this is the idea of an off-chain payment channel. And just to explain you how this works in principle. So the idea is, if Alice and Bob would like to transact with each other, they log in a certain amount in the chain, and then they can conduct an arbitrary number of instant transactions with each other. And all these transactions, they do not really show up on the blockchain. And only if they agree that they reached a final balance, then they settle to the blockchain. So if we assume they conduct 100,000 instant transactions, we will only see the first funding and the last settlement transaction on the blockchain, but there is no way to see what's going on in between. I'm also bringing some good news regarding this. So this is actually a paper that was published on Archive today, or at least the updated version. So we looked into this and really tried to understand if it's possible, if and to what extent it's possible to basically connect the dots between off-chain payment channels and the blockchain in order to possibly investigate transaction flows between these services. And we found that there might be some ways, but if you're interested, I'm referring to this paper. And also important news, in Austria, we're having a research project which actually tackles challenge 1 and 2. So there we are investigating methods for looking into smart contract token flows, and also into methods for better understanding off-chain payment channels. So this is a takeaway if you're interested. The third challenge I would bring up today is the most recent one. And it's the challenge it's a challenge that can be subsumed under the term decentralized finance. What does this mean? So you might be aware that in traditional finance, different types of services were somehow physically co-located, even physically co-located with institutions having their own balance sheets where they basically booked transactions. And when you look into different financial services, you see different players in this field, and they act more or less to a certain extent independent. And the idea of decentralized finance is really to disrupt this business model and to provide similar services on a distributed ledger using smart contract technology. So we are now seeing DeFi protocols for loans. We're seeing DeFi protocols for arbitrary assets. So you can, for instance, wrap your Bitcoin in a token which you can then use on the Ethereum blockchain. So this is a type of asset. We see derivatives coming up, so options, futures, all the stuff. And we also see novel forms of exchanges coming up, so-called decentralized exchanges. So developments in this field are fairly new, I would argue a bit more than a year. But what we see is a tremendous uptake worldwide. This can be seen in the market capitalization, which increased quite a lot. So especially since, I would argue, August, September last year, this is really taking off. And if you start playing around with services like Compound or others, you suddenly see that there are actually billions locked in. So this is really something that's gaining attention and traction. And I think it's also safe to say that hardly anyone really understands what's going on there. And there is one specific type of DeFi protocol I would like to pick out in the context of this talk, because we're talking about money laundering. And that's actually the concept of a decentralized exchange. And this is, I think, a major issue when we're talking about AML and CTF, because I mean, a decentralized exchange is just a smart contract that helps users to exchange crypto assets in real time using smart contract technology. And the big difference between centralized exchanges is that, of course, these exchanges do not implement any KYC or compliance measures. The similarity to centralized exchanges is that the volume exchanged in DEXs are almost at the level of some even larger centralized exchanges nowadays. So this is a big issue, and to be honest, I'm not aware of any progress that has been made in the context of DEXs and AML so far. So no compliance in decentralized exchanges is a major issue. And the broader picture is actually this one. So what we see is, I would call it crypto assets meet financial engineering. Some researchers also use the term financial Lego. I use the term crypto finance. So this is what we are seeing right now: financial protocols and products built and combined with each other based on different types of DeFi protocols and assets. Honestly, I'm working in this field for quite a while, since 2013, and I think I fairly understand most of it. But understanding all the protocols and what they do is at the moment hardly possible. And of course, it's an interesting research area. This is also why we are getting engaged in this field as well. So we really would like to better understand what these protocols actually do. We would like to understand what the opportunities and risks are associated with these emerging financial paradigms. We also would like to know who is behind those products and how these actors are intertwined, which of course also relates to what Elena mentioned before. Knowing who is active in the field is very important for KYC purposes. And we also would like to, so if this thing really grows, I think at some point we also have to start thinking about systemic risks. And this is also something we would like to investigate in future, and maybe also to think about some regulatory measures. And also the good news is EIT and the Complexity Science Hub in Vienna, we joined forces beginning of, or actually in December 2020, and we built up an interdisciplinary research group which just focuses on this issue and tries to find answers to these research questions. Yeah, if you would like to know more about GraphSense, let me know, drop me an email or just Google for GraphSense. You will find the website, you will find the source code if you're interested in. If you're interested in the sorts of crypto analytics studies we did in the past, just some references. So we investigated the mining shares, so how the mining shares are distributed, where we actually found confirmed that the whole thing is very centralized. We also analyzed ransomware market a while ago. We also analyzed millions of sextortion emails and the financial streams behind this phenomenon, which also led to some interesting findings. And yeah, we're also working with people who are designing proof of stake protocols to better understand how they could behave in the wild. That's it from my side. Thanks for your attention. If there are any questions, I'm happy to answer them together with you.
Thank you, Bernhard, for your interesting talk.